In this video, we're going to talk about two continuing topics, if you will, with money market types of investments. We're going to talk about risk, and we'll talk about the inclusion of money market instruments into financial plans. So the primary risk with any type of debt instrument is credit risk or default risk. And of course, that's the risk that the borrower might not repay on a timely basis. Now, with these short-term types of investments, typically the credit risk is relatively low. And indeed, for Treasury securities, credit risk is zero, that there's no chance that the government would default. But when you go to commercial paper, there is a chance. With some of the other types of money market instruments, the risk can increase a little bit more because of maybe some international influences. Interest rate risk is the risk of value that happens with a change in interest rates. With money market instruments, with the fact that they are so short in time and in duration, interest rate risk is relatively low with respect to these assets. So again, we have relatively low credit risk, relatively low interest rate risk. Liquidity risk then is the potential loss that could occur from converting an asset in an investment into cash. And again, with respect to these money market instruments, this risk is relatively low. The assets are considered to be very liquid. Treasury bills effectively are cash. You can actually use a T-bill to pay a bill if you wanted to. So the relative risk levels with these types of investments, although it's present, it's very, very low. So what does the economy do then to liquidity needs? Well, in poor economic times, liquidity is especially important. We need to have liquidity. If a person loses a job, maybe they're working fewer hours, they're getting lower returns. Again, these challenges happen to all of us in weaker economic conditions. So liquidity or the need for liquidity is heightened at this time. So this again is a time where we should be allocating more funds to liquid investments. But again, it's also just a good moral, if you will, of the story that we should have some emergency fund set up so that we can adequately cover these emergency kinds of situations when they occur. There are a couple of websites that are kind of important relative to getting data. One is Kiplinger.com. It has a great set of tools for financial planning. And also www.zacks.com has a finance link for various kinds of planning subjects. So these aren't the only two, but these are two that are very popular and certainly are available and have some good information for us. So let's continue to think about risk management, right? Whenever you're thinking about any type of an investment decision, whether it be short-term or long-term, again, we have to consider the risk-return trade-off. We should recognize that money market instruments are relatively low risk. They're going to have relatively low return. We shouldn't be concerned about the return aspect. We want the low risk so that if and when we need this money, it's very possible that we can get there very quickly. So again, the liquidity need outweighs the returns that are available with these kinds of investments. So how should we allocate our money, right? We certainly need to anticipate some bills so that we make sure we have enough money in our checking account. We need to estimate, obviously, whether Is there something coming up in the near term that we know we're going to need money for? And of course, any remaining funds, we want to try to maximize our returns given our risk tolerance. So what does this mean? Essentially, you need to plan ahead. Make sure you have enough money over the next 3 or 4 months. If you're doing a budget, you should know if you're going to run into cash deficits. We should always make sure that we have an emergency fund. Again, they say, they in quotes, that you should have 6 months to a year of after-tax income in an emergency fund. So, if you're making $60,000, $70,000 a year, you probably have around a $2,000 every 15-week paycheck. You should be putting away money from every paycheck into this emergency fund, because you're essentially going to need, again, 2,000 times 2, 4,000 a month. You need at least what? 4,000 times 6. You need at least 24,000 in an emergency fund. That's huge. But if you just had 4,000, just had 1 month certainly will be utilized to offset any short-term kinds of emergencies that you might have. Then start building on the rest. Interest rates, as we mentioned they're very low. Again, that shouldn't concern us, because that's not why we're investing in money market instruments. So with this low interest rate but good returns on stocks, we have to resist the temptation to move from these short-term things to stocks. Why? Because there's 2 different investment objectives here. We need an emergency fund to grow. We need a retirement fund. They are 2 separate things. So again, we have to think about these rainy day accounts, and that's what the purpose is for this money. So again, if we could just put away, again, figuring a $2,000 paycheck, right? If you could just put away $100 a month, that wouldn't take all that long to get to a position where you could have a couple of $1,000s in an account to cover any kind of emergencies that you might have. So in the end, right, the key money management decisions at play here are, we have to ensure we can pay our bills on time, right? We have to have adequate liquidity in order to cover any unanticipated expenses. This is our emergency fund. And again, in the end, we have to have decisions for what to do with any extra funds that we might have. Should we put it away short term, or should we put it away long term? These are the decisions that we're faced with when we're thinking about this short term money. I look forward to talking to you in the next video.